you getting ready for retirement? Yes, it's that time of the year again. Time to pull out the charts, read the books, study the numbers, and choose where to invest your RSP money. The vast majority of Canadians wait until now to do anything about RSP investments. Then they scramble to squeak in under the February 28th deadline. So, as the deadline looms, the question is, what should you do? Joining us tonight, 13 days and counting, Ranga Chan of Chan Carmichael and Company, and an author of several books on personal investment. Gail Vaz-Oxlade, a columnist with the Globe and Mail and author of A Woman of Independent Means. And Richard Croft, a portfolio manager with the Croft Financial Group. Before we get started, Group, let us take a look at some of the numbers inside the RRSP industry in Canada. Throughout the 1990s, an average of 31% of Canadians contributed regularly to their RRSPs. But the amounts have changed dramatically. 1991, Canadians contributed $16 billion. That number rose steadily over the next few years, reaching more than $26 billion in 95, and then hitting a high of more than $27 billion in 1997. But in the 1998 tax year, that's the last one for which figures are available, contributions dropped for the first time in a decade, landing at $26.6 billion. Now, what kind of RSP investments are people making? 20%, some of their money in bonds. 24%, stocks. 34%, RSP money in GICs or term deposits. But the majority of investment still going into mutual funds, where 2/3 of Canadians put their retirement money. In fact, Canadians have a total of $330 billion invested in mutual funds, about half of which is in RSPs. And you look at those numbers, Gail, and you are blown away, and yet the shine is off RSPs now, aren't they?
Yes, it is.
Why is that?
Well, in Canada, our savings rate has been in a steady decline. For the last 5 or 6 years, it's sort of just been going like this. And we're right now, the average Canadian is saving about a third of what the average German or the average Japanese is saving. So we're at a rate of about 5%, which is pathetic, because you can't possibly maintain your emergency fund, take care of your retirement planning.
Twice as high as the Americans, though, isn't it?
That would not surprise me at all.
No.
The fact is that North America as a whole is very consumer-oriented, far less concerned about making sure that they have some money put away just in case.
But this is a 40-year-old instrument, Richard, RSPs.
Well, yeah, they've been around certainly for a long time, and I would take a flip side of that a little bit. I think we've had some very strong markets in the last 4 or 5 years, particularly in the United States. And I think if you take the value of what those markets have done and the savings rate together, I think a lot of people find that maybe they've got enough for retirement right now and they don't have to save so much. And that might be part of the issue here. And we always talk about the Japanese being great savers. Well, the Japanese are in 1.5% on a 30-year bond, which means they double their money about every 140 years. So, I mean, they have to save more if they're going to have the same lifestyle when they retire.
Pretty tough to be a financial investor in that kind of a
very
situation.
The fact is, though, not all of us are saving. That would be all very well and good if everybody was doing that and participating in the markets. But to a large extent, the majority of Canadians, well over 60%, never participate in RSPs at all, which means that, they have nothing put away.
I can't pick up the paper these days without reading a different story, probably every day or every other day, Ranga, where you don't read about some 25-year-old whiz kid who's figured out, some niche in the new economy and doesn't want a financial advisor, thank you very much. They're going on the web, they're finding out all of how to do this by themselves, and they don't need RSPs, they want to do it themselves. Is that part of why the shine is off this investment?
I think in a sense, yes, Steve. I mean, there's no question the internet and the web is revolutionizing things in our economy and, in fact, in the world at large. What the web brings to people, of course, is information. In the old days, I mean, information was in the hands of the brokers, financial planners, etc. But now when you click on any website or any decent website, you get tons and tons of information. And people certainly are looking at the web and sort of trying to figure out for themselves that they could do it cheaper. Now, sometimes that's a bit dangerous, but nevertheless, the web is truly revolutionizing things.
Mutual funds, though, for your money, still the place to go?
I think for the vast majority of people, absolutely mutual funds are the place to be in. For the simple reason, first of all, Steve, they give you instant diversification. Mm-hmm. Secondly, you don't have to decide which particular security you should buy or sell. That's done by a professional manager. So there are lots of advantages, but as I say, the two key ones are professional management and instant diversification.
Okay, we've got Paul Martin's budget coming out in a couple of weeks, and I know, look at you all three smile already, and I know you're all anticipating...
A tax cut.
Not just tax cuts. Talking to Mike Harris again? No. I know you're not just anticipating tax cuts. You're anticipating Paul Martin loosening up on the foreign content regulations. Now, what is it now? What do you hope he does? And why would it make a difference to the people watching this show?
It makes no difference to people watching the show because they can get all the foreign content they want with clone funds, index derivative funds, linked GICs. I mean, there's a number of ways they can get all the foreign content they want.
Well, he seems to think he's doing a big thing here by increasing the foreign content.
A big whoop about nothing.
Yeah, exactly.
Is what it is.
Don't hold back. Tell me what you really think.
Yeah, don't sit on that fence. He'll raise it to 30%. He'll probably do it 2% a year for the next 10 years or 5 years. You know, that's what it'll be.
I wish he would just abolish it completely.
Absolutely.
Because if he were to do that, we as investors would benefit overnight. Reason, Steve, I mean, all these index funds, clone funds, etc., they are charging an extra 0.5 percentage point, which is understandable because they have to use derivatives, etc. But if they didn't have to do that, we would all get at least 0.5 percentage point in our pockets, and over time, that would certainly amount to a lot of change.
Now, just to add to that, I think this may be the year Canada does very well. Actually, we did much better than the U.S. last year. So, you know, we may be raising the foreign content, everybody rushing to clone funds, because that's been the biggest selling area this year. There's no question about that.
Can you just describe what a clone fund is for those who haven't heard about it?
Clone fund is where the mutual fund owns a basket of GIC, or guaranteed investment certificate, treasury bills. They have that. They swap the returns on that for a basket of stocks in the U.S. or the foreign market they want to be into. The manager picks the basket of stocks they want. They do a swap in terms of the rates of return with a broker in the States. Somebody like Morgan Stanley does a lot of this work. And so what the mutual fund looks like is a fund that's actually holding a GIC, but the returns on that GIC are actually the returns on this basket of stocks down here. And you pay for that. As Ranga says, you pay about 50 basis points.
Which is okay unless the Canadian dollar keeps going up.
Well, that's interesting. Like the Canadian dollar on a fund inside an RRSP only impacts the actual positive or negative return of that fund, because don't forget, most of the assets are still in that treasury bill. That's a real tricky thing, and you get some very interesting things there. But
I think, Steve, you raised a good point on the Canadian dollar.
Absolutely.
There's no question. I mean, the great danger that I see is Canadians running into international funds, of course, is as the Canadian dollar strengthens, and most of us are expecting it to strengthen, perhaps not tomorrow, but over the next year or so, that will most definitely cut into your returns when you switch your money back into Canadian dollars. So it's ironic, as you say, that, I mean, here's a period where the Canadian stock market is doing extremely well, one of the best ones, in fact, of all the industrial economies, at least over the last 12 months. Now you're finding precisely the wrong time. Canadians are moving out of Canadian equity funds and into international funds.
But part of that,
big danger.
Part of why people are moving away from Canadian equities is not all equities in Canada are doing as stellarly as people like Nortel and BCE. And unfortunately, what's happening is our TSE 300 is being wildly skewed by the presence of these particular two companies. And so people are looking at the TSE 300 and saying, well, it's getting, you know, this phenomenally great rate of return.
When in
but
fact,
the 3 or 4 stocks I'm holding that are Canadian aren't doing that.
But
so
Nortel
maybe
and
what I
BCE
need to do is I need to go abroad to get the kinds of return that the TSE 300 looks like it's promising.
So when Paul Martin gets up and makes this announcement that I'm increasing the foreign content, you're all going to yawn.
I think so.
And he's going to look for a huge bang for his buck on this,
well,
right?
you know, what we've seen so far is a lot of noise about foreign content, when in fact only about 20% of RSP holders are even at the foreign content limit. So we're not even taking advantage of the 20% we do have.
Well, we are probably taking advantage of it. We're probably taking advantage of it with the derivative-based funds. I mean, they're probably there.
But those are sophisticated products, and not a lot of people even understand them.
To a point, you're right. But Paul Martin's tax cut, we'll be able to know a whole lot about Paul Martin's tax cut when you see all the bravado around the RSP increases. Because if that's the big issue, then the tax cut's going to be nothing.
That's right.
Let me ask you, Gail, about, I saw this statistic today, and I couldn't believe it. People are not contributing anything close to what they could be contributing.
No.
In fact, there is $242 billion in unused capacity.
That's right.
Why don't people contribute as much as they can?
Because we don't save. It comes back to this basic difference in the way we perceive how we need to manage our money and other people perceive it. You know, other countries see that saving is important. If you don't save, then you won't have later on. But we don't save in Canada. What we do is we spend. So for every dollar we put away, we're spending $5 or $6 or $7, usually on a credit card. So we're paying interest on top of it. The basic problem is our unwillingness to accept the fact that we have to save some of our money.
If we don't save,
I don't think so. I mean, you've got a bit of a point there, Gail, but I mean, one of the main reasons why Canadians are not saving is, remember, the 90s was a horrific decade for us, at least for the vast majority of Canadians.
Only the first half. The second half saw our economy getting stronger and stronger.
Yes, certainly the economy was getting stronger. Certainly certain segments of the economy did very, very well, but a large section of Canadians, I mean, they were struggling to keep their head above water. And common sense tells you, as the longer that continued, they started to draw down their savings. And I agree that's a risk there, but that's actually, I think, one of the key reasons why our savings rate is very low, and it indeed is the case why savings rates are very low in the U.S. The danger, of course, is if the U.S. goes into a recession, or I shouldn't say a recession, if the U.S. stock market corrects, the big fear that the Americans have is, of course, that that's going to impact immediately on consumers because we don't have any savings, and that'll drag the U.S. economy down into a recession. And
well,
that is a fear.
It's what Greenspan is watching as well.
Absolutely.
Because one of the things that he's using to predict or to decide whether he's going to put his interest rates up or not is how much of that paper-based wealth is being used to leverage people into more consumer items. Things like bigger houses, things like bigger cars. So how much of paper-based wealth, which really isn't wealth until it's cashed in, is being used to borrow for the
Speaking
future.
of which, do you want to tell people, do you want to suggest to people in these relatively buoyant times that if they have unused capacity for contribution, they should go out and borrow the money to put it in?
No, I wouldn't. I would take the other side of all of this. I saw an interesting statistic. I do some consulting with a couple of large insurance companies, and I saw some interesting statistics on their RIF payouts. 60% of the people, particularly one company that I've been with for about 4 years, about 60% of the people drawing on RIFs wish they didn't have to take the minimum. And I found that fascinating. That's a fascinating statistic to me. Because what it's doing is it's pushing them into a higher tax bracket, and they're getting taxed at a 70% level because they're getting clawed back on the old age security and all the other pieces of the puzzle. I mean, let's not forget what an RSP is, a tax deferral mechanism.
Right.
And if you're 55, 60 years of age, you get 9 to 14 years of tax deferral. Now, there's a question of how much advantage there is to that if at the end of that cycle it's coming out at the same tax rate it went in at.
Well, there's no point, obviously, if it's coming out at the same rate.
Yeah,
the idea is to come out
Except for the compounding growth, because it'll grow dramatically faster on a tax-deferred basis in an RSP than outside.
normal middle-class folks, you want to tell them to borrow money to fill up their RSP
I
space?
would never say
You
such a
wouldn't do
thing.
that.
What I would say instead is, let's pretend you borrowed the money and you were making regular monthly payments. Put that money into your RSP as much as you can afford and catch your RSP up that way. But why pay interest?
Even if it's $100 a month, put it in anyway.
Yeah, absolutely. If it's $25 a month.
Okay. Let's talk about, where will I go here? Let's talk about Canada versus the world in terms of where to invest money. We're supposed to be doing better next year. Canada, as a country, better vis-a-vis the United States, maybe not better compared to Asia. You want to weigh in on that and say how we're doing?
I mean, in terms of economic growth, the Americans are still going to do well this year. We definitely think for both the United States and Canada there is going to be a slowdown taking place. Having said that, Steve, it's like going from about 4 to 4.5% down to about 3.5% or so. But the key here, it's a policy-mandated slowdown. As Gail was saying, the Federal Reserve, they're tightening, raising interest rates in order to try and cool the economy down because they don't have a breakout of inflation. So that's what's happening in North America. We're expecting a slowdown in the year 2000 and 2001. Opposite is taking place in Europe. Europe growth last year was about 2%. This year we think growth is going to be about 3%.
So if you're looking at instruments, what areas of the world ought you to be looking at?
Well, I think, first of all, investors should have a well-diversified portfolio. I know it's motherhood, but it really makes a lot of sense. Don't ignore Canada, because Canada is going to do well as well. But you need to have some money in Europe. You need to have some money, a little bit of money in Asia and Latin America. Both those regions are bouncing back dramatically, particularly Asia. And who would have thought just 2 years ago, and we were all had written off Asia.
Not me.
And now, no, that's true, not you. And now you find that South Korea, for instance, last year posted a rate of growth of 9%. And 6 months before the numbers came out, every pundit was saying that South Korea was going to continue to contract. So a lot of growth is taking place, and what it tells me, though, is be diversified. But again, I do want to bring this whole point about currency. If you're going to invest internationally, don't forget the currency impact. If the Canadian dollar strengthens, that will cut into returns.
Sure.
There are some studies out there, too, and just to follow up on that point, if you get beyond 35% foreign content, you run into the issue where the currency risk will have as much impact on the portfolio as the performance of the foreign market. So it's a very big issue.
Can I ask you what you're doing with your dough this year, this time of year?
Well,
more than any of us.
I've held with Asia. I kept buying Asia when Asia was...
Even when everybody was panicking, you hung in there.
Absolutely. And, some of the best advisors that I have kept saying to me, well, Asia's not going to do anything. You should probably get out of Asia. And I kept saying, well, this would seem to be the time to buy. And I've been holding a mutual fund. I was holding Trimark Asia Pacific, which holds some India. And it did awfully for the longest time. And now it's like it's just going through the roof.
Coming back.
So, as Rega said, I believe that if you look to the opportunities in Europe, Asia, and Latin America, and balance yourself up, and probably not go over the 30%, then you're probably going to be fine.
Let's do this in our last couple of minutes here. Just give some people some basic advice. We are being bombarded. You can't turn on the radio, the television set. You can't walk into your bank. You can't call. You can't do phone banking without first having to get through a commercial about where to put your RSP dough. Okay? Ranga, give people some advice. What do you want?
I think when it comes to ads, etc., honestly, ignore it. Ignore all the noise out there, because remember, companies understandably are in the business of selling and promoting their products, and that's just going to confuse investors. Don't do rear view investing either. I mean, when you're looking at the ads that appear in the newspapers, they will say a particular fund delivered 100%. Well, that's yesterday's money.
What are you going to do? What have you done for me lately? That's
exactly.
Right.
You know, I think there are certain rules of thumb that people should follow. One, have a decent financial plan. It's amazing, Steve, the vast majority of Canadians don't have a plan. You need a plan because that's your roadmap as to where you're trying to get to. Secondly, when it comes to mutual funds, pick funds with good track records, but do pay close attention to management expenses.
There is a sense, Richard, that if you haven't been putting money away since you were 20 years old, that once you're 35 or 40, it's too late. You're going to be poor when you're old. Do you know what I mean?
No, I don't believe that. I do think, though, that maybe...
But that's the pressure banks put on you to get in early.
It is, and I think it's a mistake. But I will say that I think that we sort of have the risk spectrum on investors wrong. I think the individual who's 25 probably should take less risk than the person who's 80. And I think it's just to make a mistake at age 25, if somebody just did some of those compound calculations for the next 40 years, the cost of that mistake is dramatic. To me, the person that can take a risk is the 75-year-old who's got more money than they need, and they want to go take $20,000 and buy pork bellies, go ahead. So I think, you know, they ought to take a hard look at risk. I think they ought to have a diversified portfolio. I would be aware of the 35% and over foreign content and currency issues around that.
You guys are great. Thanks for the advice. Up next, Women's Institutes, a rural tradition in Ontario.
I do believe we have been a feminist group. It's just that we've been quietly going about it. And I guess we're doers, not talkers.